All right. Welcome back to the latest edition of the InvestTalk Wealth webinar series. We are just at 1 o'clock, so give a few more people time to jump on. It looks like we're still building up here.
Yeah, we were saying we need to fit in a webinar in Q3 2025 and just made it.
Just
Just
under the
barely
gun.
made it.
Just under the gun. Yeah, well, I mean, if you will go by market close, we're past it. We missed it.
That is true. That is true.
Mark,
Though I do think that you clicked the start button just before I heard that bell go off, so I'll count
okay.
it.
Okay, we'll count it. Just before the bell. All
Exactly.
right. Let's see. Looks like our participant number is leveling out here. Oh, nope, still going.
We'll
Okay.
climb in a bit. We'll give a couple minutes.
Yep. All right. Well, I'll kind of just start with the concept of this webinar. This is probably the one I've been most interested and excited to do in a while, mainly because it kind of harkens back to my early days in this business. I really started in high school in the late 90s when the dot-com bubble 1.0 was bubbling up. And so, there's some uh, there's a novelty to this current boom and mania that harkens back to my early days. So a lot of interesting tidbits I'll bring, as well as just history lessons that we can take. So that's why I'm excited about this webinar. What about you, Luke?
Yeah, it has been the singular growth driving theme. Well, not singular, but one of the biggest growth driving themes of the past couple of years, right? And typically, when these things do happen, people narrow in and they focus on one aspect of it. But when you take a step back and see the bigger picture, you can really see there are different areas in which you can invest in different ways in which you can benefit from these types of things. And I think taking that longer, wider view is an exciting thing to talk about.
Cool. All right. Well, let's get started. Obviously, most of you know myself and Luke. And this is our agenda for the day, for that next, try to do about 45 minutes or so in total. I'll give you a brief market update, and then we'll get into the background of the AI trends right now, and then the energy and the industries that will benefit, and then how to profit beyond just the tech space, which is frankly probably where the better long-term opportunities are. Now, I'll start off with the market as a whole. We've really been in a growth phase since the bottom of COVID. We had a brief, I would say, markets breather in 2022, but the economy continued to grow. So we've been in this growth cycle for a little while now, and the question is, where are we? And I'll give you the positives and negatives. And we'll start off with the positives. I think positives are underappreciated by most people. The It's easy to get caught up in headlines and clickbait about bearish news items, especially in today's hyper politicized world. But investors always have to balance the pros and the cons of the broader macro environment as well as individual sectors and companies. So we'll start with the positives of the market and the economy, and that's consumer balance sheets are strong. Most people who have uh, own a home, their values have gone up. They have a lot of equity in their home. A lot of them are locked into 2.5, 3.5% mortgage rates, and their incomes have gone up with inflation. And so their disposable income is relatively high. Also, a lot of people got stimulus checks during the pandemic and were able to pay down debt. Now, that's in general. There's always pockets where that are not strong, but overall, consumer balance sheets are strong. Bank lending is growing. I'll show you a chart in a little bit. That's always a giant factor, an underappreciated factor. And government deficits are rising, and the U.S. government deficit is rising. You have other governments like China as well. They're spending a lot. And so government spending is a very underappreciated factor in the growth of the overall economy and liquidity. Earnings growth remains positive, And a lot of this is CapEx. Yes, it's AI driven, but overall, earnings in the economy, although slowing in its growth, is still positive. Credit market remains calm. You're not seeing any major disruptions there. The Fed has begun an easing cycle that is steepening the yield curve and will likely incentivize growth going into, or incentivize growth of lending going into next year. And then the unemployment is low, even though businesses are not hiring. That's number three on the negative side. Businesses are not really hiring. They're not laying off a lot, but they're not hiring either. Gold is signaling rising political risk both domestically and abroad. You see that with the Middle East. You see that with Russia and Ukraine. You see that here domestically with what's happening, the political divide that we're seeing. And then you have fiscal uncertainty. You have the not debt showdown, the budget showdown right now, and it looks like we'll have the government shut down for a little bit. Who knows how long? Usually, it's a sideshow. It doesn't mean a whole lot, but going into next year, you also have some other fiscal uncertainty around how much will the deficit really grow. And then debt maturity will accelerate into next year, not only on the corporate side, but on the government side, as well as a lot of what the Treasury's done is issue on the short end. And then inflation is reaccelerating. We talked about this in the beginning of the year, that while we were kind of getting closer to that 2% target in the back half of the year for various factors, including a weak dollar, inflation was going to reaccelerate toward 3% by the end of the year. And that's kind of what we're headed towards, around the 2.7, 2.8 by most measures. Tariff impact still not fully felt. We still don't know how it's going to impact the consumer and businesses fully, partly because it's not, it's kind of disjointed on the implementation of the tariffs, and then a lot of companies front loaded their orders before the tariffs, and now they're finally running low on inventory and they're having to reload, and that is at higher tariff rates. So then there's Bitcoin weakness. It's gone up, it went up yesterday, but still is not really able to break out. And that is a leading indicator for broader liquidity. So something we continue to watch. And then housing remains relatively weak, especially on the existing home sales. And then here's the chart from bank credit. You see this is a year over year chart of all commercial banks. Now, a lot of this is going to private equity, lending to private equity in areas that are not exactly productive. But in general, bank credit is rising up about 5% year over year. And that hasn't really rolled over. If it rolls over, that's a bigger story. It's just kind of consolidating, hanging around this 5% mark, which means it's fine. But then there's the gold miners to equities as a ratio. And so what you can see is gold miners, anything gold related, precious metals rising. And so that is just signaling a broader, both political, geopolitical, and fiscal issues ahead. And so, there are risks out there, but what you can see is even though equities are doing fine, those harder assets continue to do better. Now, that's the broad market overview, but let's talk really about AI. And I'm going to get into some themes, and Luke is going to step in here in a second. But we'll start with the traditional AI themes. And everyone talks about the main we call hyperscalers: Amazon, Alphabet, Meta, Microsoft. They're spending $364 billion this year. That is a massive amount of money. And the first order beneficiaries are the ones that really have taken off because of this. You think of your NVIDIAs of the world, your CoreWeaves, your anything that is super AI focused is up dramatically over the past year, 2, 3 years. Okay. So GPU manufacturers, obviously, cloud infrastructure providers, so a lot of these are sub uh, arms of bigger companies, right? AWS is Amazon Web Services. This is a large part, but a part of Amazon, not a pure play. And then you have the semiconductors and hardware companies, so Broadcom, so other types of chips that go into AI cloud servers, for example, and then Oracle. And I mean Oracle. I'm actually meant to put Cisco. I realized that. Cisco's probably more of a hardware company. AI software platform is also doing well. So ChatGPT, Gemini, Claude, and many more that are out there in development. And so they're certainly benefiting and getting a lot of hype around, their ability to add subscription revenue, and they are growing in a dramatic way. But the bigger question, which we'll get into a little bit, is are they spending too much for the requisite amount of revenue? And that's where I think the common investor pitfalls are something you have to really call out here. And this goes back to what I was talking about, the late 90s. And there was very similar kind of setup, right? That internet was going to transform the world, and you had to get in on the internet play. Anything with a .com after its name, it got a ton of capital, and despite knowing anything about whether it had a business model that was economical or sustainable, money just flew in from investors. And you're kind of seeing the same thing with AI. Companies are changing their story and their pitch to Wall Street by incorporating AI, even though maybe it's not really AI, it's just some basic form of machine learning, or maybe they're just subscribing to ChatGPT or OpenAI's models, et cetera, and incorporating in what they do. So just because it says AI and it works around the AI space doesn't mean that it's has a sustainable business model or that it's going to be a great long-term investment. And that's what you saw in 2000 is, these a lot of these names, like an Oracle, had huge, or was it Cisco? Sorry, Cisco had a huge. There was Cisco at one point was the largest market cap, and still is not back to those levels. So what you can see is just because there's hype and it's working in that space does not mean that it's automatically a great long-term investment, because a lot of them have low or negative cash flows, and that's what you saw in 99 as well, despite high revenue growth. So this is where it comes to overweighting first order beneficiaries, which we just talked about, and ignoring the fact that AI is often adding to operational costs and making margins tighter for a lot of companies. Because if they're adding that additional cost but not making it up in incremental revenue, well, that just actually impairs their overall business model and profits. And so making sure that they have enough revenue to make up for that spend is important. And frankly, that's not happening in most verticals. And then lastly is not identifying the circular business models that you're seeing. NVIDIA is big into this. They're investing in companies like CoreWeave and OpenAI, et cetera, and all they're doing is turning around and buying NVIDIA chips. And so it creates revenue concentration risk. And this is something that you saw back in 2000 as well. So make sure that when you're looking at these trends that you're not falling victim to the common investor mistakes that have been made in the past. And speaking of the past, let's talk about the previous technological revolutions that are out there. And we'll just hit on a few. So automobiles, one, the automobile industry historically has been very competitive, very low margin, highly capital intensive, versus companies like a Walmart, for example. Since 1980, Walmart's returns from an equity perspective have been 70 times what Ford is. Why? Because the car allowed urban sprawl and the logistics networks that allow Walmart to source products cheaply. And so the automobile was something that benefited Walmart far more than Ford. And then you can go to even further back and look at railroads, telephone, telegraph. These were all revolutionary technologies that required a lot of upfront costs, a lot of capex. And there was a wave of bankruptcies because most of these companies spent way too much without understanding the ROI on that spend. Sound familiar? Well, the beneficiaries of these technologies were, once again, Wall Street, media, other types of businesses than the first order companies that were impacted by these technologies. And then you have electricity, obviously very heavily regulated utilities, and then they enabled other types of businesses like assembly lines, electric appliances, et cetera, and those did much better than the overall utilities. And then lastly, you have just the internet, right? The most recent major technological wave, and Netflix returns on Netflix stock were much better than, say, Cisco, for example. And so just because it is tied to these new technologies, the companies tied to them, does not mean that it's automatically going to be a great long-term investment. And the lessons here are there's about four of them. But initial movers bear the cost of the R&D, and therefore it creates a ton of risk for those companies, a ton of risk. And that's why, anything AI related with these high valuations is extremely risky to be investing at this time. And then you have commoditization, right? That the infrastructure has happened with fiber back in the 90s, where tons of fiber was laid and just try to get information through the internet. And ultimately, that just became a commodity. There was no difference between one fiber or another. And you had names like WorldCom go bankrupt. And then obviously capital intensive upfront investments, and then competitive pressure. Many of the leaders within this new space suddenly try to just survive. And they raise capital at high valuations, and everyone is very easy to load on debt. And suddenly that no longer is easy to maintain because of the economics of the business. So that is the lessons of AI, but Luke is going to get into kind of the picks and shovels of the industry and where the better opportunities long term probably lie.
Yeah, and then when we talk about picks and shovels, right, it's an analogy to the gold rush, right? The people that were selling the picks and the shovels, the Levi Jeanses of the world, did really well in supplying the tools necessary for those miners to go out there and try and find gold. Not every person that did really struck gold, but the companies that supplied those tools did a very good job. And in the same way, there are tools that are necessary for all this capex spending to happen, for all of this innovation to occur. And the number one thing is really energy, because energy is the lifeblood of AI. Global data center consumption is projected to more than double by 2030. You see global data center electricity use right now sits at about 415 terawatt hours. More than double is just the base case over the next 4 years. And the reason why is because how much power each data center is drawing. One large AI data center can be drawing as much as 100,000 homes, 100,000 homes. And there are some that are even larger than that. In places like Virginia, more than a quarter of electricity is already being used by servers. So it's not really a side story to what's going on with the growth of electricity, the growth of power usage. It really is a main driver of what we've been seeing with revenue returns within utilities, within energy companies that are focused on electricity over the past couple of years. And so with this data processing in general, it will soon rival the heavy demands that we've seen in other industrial spaces. And so when you go to this next slide, what this just shows you is depending on how big the data center is, right, is really going to show you how much power it is using and how analogous it is to a city, a 300 megawatt AI data center. Because remember, these things are running 24/7. It's 24/7 demand. It's not like us who are sitting in our homes. During the summer, we may use air conditioning more than we would in the winter when we'd be using heat. We don't keep the lights on all night while we sleep. This is a 24/7 load. And so a 300 megawatt data center uses as much as 250,000 US homes a year. 400 megawatt data center uses as much as 330,000 homes a year. So you can see it's an incredible, incredible amount of power. And with that, there's really been a strain on the grid and a big response from various companies and various regulatory bodies. You see in this chart right here, which is showing you the data center share of global electricity use. Right now, it's sitting at about 1.5%. That number is set to double as a base case by 2030, almost 3% of global energy usage. And so you can understand with that in mind, right, why places like Virginia are seeing some strains on their grid. Northern Virginia has seen near miss grid incidents, tough to say that, and now faces multi-year delays for new data center power hookups. Because there are two aspects of what's going on here. If you want to build out a new data center, in a lot of cases, you are building a building that has no ability to be powered because the bottleneck that is really in place right now is a lack of spending and a lack of building of this electric infrastructure. And that's why you see these tech firms that are signing huge, massive contracts, right? Microsoft paying Constellation Energy to bring back online nuclear power reactors to make up for what is the bottleneck of the AI expansion, the lack of power. Now, this next slide really just showing you how US utility capital expenditures has grown and is projected to grow into the year 2027. I mean, this isn't typically, an area that we have seen massive spending. Now, a lot of the spending in utility capital capex before the quote unquote AI revolution was driven by an expanding population and a widening population into areas of the country where people didn't historically live. Now, what are you seeing here? $202 billion in the year 2025, $206 billion in the year 2026, $211 billion in the year 2027. And a lot of that is driven by, yes, grid modernization, which needs to happen because as you expand and as you strain these grids more and more, the old technology can leave you in situations where these grids are failing. They're also, because of the Inflation Reduction Act, expanding and integrating renewable energy. And of course, those data center and AI driven demand, the primary driver of really what is moving a lot of these regulatory bodies to try and approve a lot of these projects because of the massive amount of spending that is happening globally. Now, when you are able to, right, that's just the energy side of things because the response is this massive buildup in generation and grid capacity. Utility companies ramping up capital spending to record levels. Even with that, there needs to be another piece of the equation as well. The power exists to really fund some of these booming AI factories, these massive data centers. If you want to move back a slide, Justin. AI data center construction, like this says, is set to boom by trillions by the year 2030. That's massive, massive explosion. Cloud giants, as Justin already went over, are spending hundreds of billions of dollars per year expanding existing centers in compute capacity, and they're building these mega campuses. These aren't just your, 1 square foot, 100 square foot, or sorry, 100 square acre facilities. These are massive, massive campuses, mega campuses being constructed not just in the United States, but globally. Some of these are the sizes of small cities, large cities with multi-gigawatt power needs. And so this next slide is really showing you the total amount of required investment by the year 2030, $6.7 trillion. If you want to move to this next slide, Justin, $6.7 trillion is the global data center capex needed just to meet the compute demands of what these companies are trying to create. So the demand is there. And as you know, anytime the demand is there, suppliers come in and they create the supply. In North America, you see the massive amount of gigawatt expenditures that are just under construction over the next couple of years. Right? These projects are massive. And so, with that, what does that look like in practice? Well, there are, like I said, a lot of bottlenecks here. There's long waits for grid connections. There's water permits. There's zoning approvals. There's slow projects, semiconductor fabs and cooling equipment, all these things that are incredibly necessary to build out this AI infrastructure. These places get incredibly hot. That's one of the reasons why you've been seeing the cooling HVAC industry doing so well in the past couple of years because of this 24/7 server load, this 24/7 use. And it really has led to a situation where these are the types of companies that have benefited from the infrastructure being built, not just the companies that are building the data centers, not just the companies that are building out the grids, but the companies that are necessary to support the building of these things in such scale. And so what does that really mean for you, for as an investor? What does it mean for us? Well, it means that utilities and renewable energy companies stand to do very well. They need to build and upgrade physical infrastructure for AI. And it's creating opportunities broadly across the value chain: data center specialists, construction firms, semiconductor makers, cooling system providers, network builders. All of these things are beneficiaries, innovative firms that have been able to find out how to use less power to do more, that have been able to find out how to cool with less power consumption, just given the already existing data power consumption that we're seeing across the board. And where are you putting the land? These data center REITs are seeing record demand and investment inflows. Chip makers, cooling providers, like I said, doing very, very well. And this is really what we mean by the picks and shovels. It's not just the Metas, the Microsofts, the OpenAIs of the world. It's really everything that comes together and is necessary for the amount of expenditures from those companies to be able to actually do anything in terms of the demand for compute. Now, this next slide is really just showing you the corporate clean energy procurement that I was talking about. Is that because the electricity infrastructure doesn't necessarily exist in the way that they need it, This is the amount of money that these corporations have been spending, or rather, the amount of power that they have been buying from an alternative energy perspective, and where these data centers that they are building have been located, right? It's not just in the United States. For only 40% of global data centers from 2024 to 2025 was in the United States, 25% in Europe, APAC 28%, 7% the rest of the world. This is a phenomenon not just in the United States. This is going on globally. All countries are trying to win the race for this efficient power for AI. And so you can see really where a lot of this money is coming from. It's all across the board. It's not just semiconductors and hardware, which have spent $3.1 trillion. It's power grid, cooling, electrical, $1.3 trillion. Real estate, construction, almost $1 trillion there. The investment, the amount of capital that is flowing into companies across sectors makes it really an incredible opportunity for investors to expand and diversify in a way that oftentimes when you see these secular drivers of growth, you're concentrated in risk in one tiny area of the market. But because of the way this is playing out and the way flows are moving and the way that investment is being made, it provides a lot of diversified opportunity. And so Justin's going to go in a little bit into how you can find these opportunities, how you can look at these opportunities, and what types of companies can really benefit your portfolio.
Thank you, Luke. That was great. Especially one thing that I got out of that section most of all is that just because it's doing well because of AI today, we're not saying that those are bad opportunities.
Yeah,
What we're saying
exactly.
is that it's not just in tech, it's wide ranging. And frankly, a lot of those other areas have more sustainable benefits from AI, especially if I think of like HVAC,
Mm-hmm.
HVAC systems being installed in these facilities. And no matter what type of chips are in it, right? If they start buying AMD chips versus NVIDIA chips or Intel chips or whatever, uh, those HVAC systems will likely have to be serviced and maintained. And a lot of times, that's one of the best businesses out there, is just
Yeah.
in the industrial servicing, for example, and replacement parts and things like that. And so when your install base rises dramatically, that just increases your overall profitability for those names longer term. Versus, as you know, in the tech space, it can be very, very cutthroat, very competitive, and technology can change very rapidly.
Mhm.
That's kind of the lesson in all of that. And so, what I want to get to next are those second order winners, okay? And why there are other types of names besides the big, sexy AI names that are out there now that will likely benefit the most. You know, think of the Netflixes of the world versus the Cisco's of the world long term. So let's talk about why they win, why the second order companies tend to win out. Now, first is they learn from mistakes. We're early in the AI game, even though it's been in development for a long time, right? The craze hasn't really picked up steam, and it didn't really pick up steam until about 2023-ish, that time frame. So we're only a couple of years into this. And so there's going to be a lot of mistakes that are made, many companies that go bankrupt because they overextend themselves. And so other companies can come in and learn from the mistakes. Apple is always a good example of that. They never are the first to do something, but they're patient, they work on it, and they execute on it in a way that fits with their brand ethos, with their products, and they do it in a way that's economical as well. And so that in order to learn from those mistakes, they're able to capitalize on the growth efficiently. They're still in the game, they're just doing so without as much capex as maybe some of the other companies. And so they're able to get in at the right time, and they enter when there's a lot of, think of fiber, you know, to get into the internet world, post WorldCom bankruptcy, there was a lot of dark fiber that was able to be bought up pretty cheap. And that infrastructure and utilizing that infrastructure became very economical versus the early years of the internet. And then also customers knew how to use it. They didn't have to sit there and teach customers. Right now, we're still in this phase where individuals and businesses are trying to figure out how you leverage AI. How do you really use AI efficiently, not just as a souped up search engine, but something that really automates tasks, and really creates efficiencies in everyday life as well as in businesses. And then creating new business models. You can figure out how to leverage this technology to create businesses that weren't there before, like in Netflix is a good example. It's a whole new business model. Streaming, they were kind of the pioneers there. And once again, leveraging expanding networks. So being able to utilize these networks that are maturing. And so the long-term AI winners are going to do these main things. Number one is workforce supplementation, meaning, yeah, getting rid of workers that are unneeded, that are doing low-skilled jobs that are not it's not efficient anymore to keep those people hired. And then augmentation, and this is probably the ones that will benefit the most, not just getting rid of workers completely, but making workers more efficient. Just like the computer made people that were using the typewriter a lot more efficient. Right? You transition them to a computer, things were more effective, more efficient. And obviously, that's a small example, but you're going to see this in a lot more verticals, especially white collar work. We're already seeing it here in our office. We're using AI for research and to gather data a lot faster than we would have before. Um, Companies leveraging AI for productivity gains. That's kind of very similar in that way. And those that have low skilled jobs in their workforce able to, once again, supplement those workers with AI. And then reinvesting those profits, those that will take the additional profits and actually create a human AI collaboration where it's not just keeping it all for yourself, but making your company as a whole more productive and reinvesting the dividends of AI. And then understanding how to measure this. It's not just about utilizing AI because there's a lot of we call AI slop. It's very easy to use AI and actually waste more time than it's actually than actually creating benefit. And so you have to make sure that companies are effectively able to measure the impact of AI. This is a great study from McKinsey and Company, and I'll just read off a few about the benefits of AI in business. So 44% report cost savings, and the highest performers, they cut costs by more than 10%. And AI can cut 20 to 30% of operational costs in business services. We're seeing that in many ways here at KPP. And then 75% of AI's value comes from customer operations, marketing, and sales, software, and R&D. So this is, once again, the white collar work. It's helping in some verticals, but more in others. And so this is a great estimate of margin expansion by industry. Now, healthcare looks to have the most potential impact over the next 5 years in total, but from a delta, areas like retail and consumer, they're going to do much better. Healthcare already has, mid to high teen margins typically, whereas consumer and retail businesses, they operate on very slim margins. So if they can increase their margins by 3%, in many instances, that can double their overall profits. And so this is a good starting place, but I have to understand kind of where the margins start from and how they can be improved and what that full delta looks like. And then let's talk about different industries and the way that AI is creating broader impact. And the first is healthcare. We talked about that 7% margin increase. And this is really about health system efficiencies. We know that our healthcare system is not very efficient. And we've all been at doctors' offices and hospitals where things don't run very smooth, and you're getting tests that aren't really needed, et cetera. And so this is going to help hospitals, doctors' offices, as well as diagnostics and make it all more efficient and do more with less and detect disease, treat disease, and manage the diseases as well. And we'll certainly be able to take data and find better ways for all of those things, which will help pharma companies, biotech, as well as medical device. And we're seeing that, and we're certainly investing in all three of those areas to some degree. And then software. This is kind of, it sounds techy, and it is tech, but it's other types of verticals, other types of direct AI software, but they're using uh, sorry, other types besides AI software. They're using AI for development, for insights. Think of, you have an app, being able to really drive a deeper understanding of the UI of that app, maybe of a website, and how to design that website, A/B testing, things that were done before, but doing so in a much more effective manner, with more data and doing it faster, just with the use of AI. And this will impact cybersecurity companies and as well as sales and development tools, as well. And then you get into manufacturing. This is where I think it's going to take a little longer for the AI impact to be felt broadly, but it can help with things like predictive maintenance, making sure you're doing the proper maintenance at the right time, most efficiently. So you're not doing it too soon, too late, and you're keeping your systems up and running. And then there's quality control. I think this is big as well. Instead of having an individual take a look at each product, you can use lasers and vision systems that can make sure every product is coming out top quality and you're not putting out anything that has flaws. And then there's supply chain management optimization, obviously, and robotics that become even more capable than they have been over the past 20, 30 years. And then lastly, energy companies. So Luke talked about, the energy demand, and that's certainly going to help with utility companies and anything nuclear related, et cetera. But when it comes to oil and gas, for example, drilling optimization, seismic imaging, those things are improving rapidly as well. And renewable optimization, this is big because we know the sun isn't always shining and the wind isn't always blowing. But there are ways to utilize AI to maximize the ability for those renewable options to pencil out and make sense. And so I think that's a very important aspect to all of this, to utilize AI to help AI flourish. So that was pretty much the long and short of it. We're going to have a Q&A here in a session, in a second. But I want to remind you, if you need help with this, you need to figure out whether your portfolio is aligned with the not just the first order, but second order impacts of AI. We do offer a comprehensive portfolio review. It's for free. This is the reports that we can give you, and we have different strategies that we deploy for clients. We figure out which one would make sense for you based on your goals. This is a QR code, so if you do want to submit a portfolio review, all you have to do is bust out your phone and your camera, and it will take you directly to our portfolio review page if you want to complete one of those, or you can just reach out to us in any of these ways. Obviously, we're in Irvine, California. There's our phone number and our website and our email address. So with that said, I will get into some Q&A.
It looks like we got the first question that came in a little bit ago from Colin Sutherland. It says, how would you hedge the downside of this big CapEx boom if productivity and applications underachieve? Well, that's actually exactly what we've been talking about, right? When you talk about productivity and applications underachieving, that means that the margin compression would happen in the big software hyperscalers. Where the margin compression would likely not happen is with these grid infrastructure companies, with these cooling companies, with the companies where the massive investment isn't really contingent on the success and productivity of the applications. It's contingent on the energy demand. And whether or not those things are successful doesn't mean that the demand from the data centers isn't there, which is why you can invest in this theme while giving a little bit of a hedge should productivity and applications underachieve.
Exactly. And the lesson from the past is that a lot of companies went belly up because they over levered their balance sheet, and then demand suddenly went in reverse and they had negative cash flow. They invested too much in capacity. And this happens in the chip industry a lot. Not to say that's absolutely going to happen this time, but it's definitely an industry that's prone to over building capacity. And then when times are tougher, their cash flows go negative and their stocks shrink dramatically, and some of them end up going bankrupt or getting acquired at low prices, et cetera. And so that happens a lot as well. So for me, it would be focus on companies that are that have good balance sheets that aren't over leveraging themselves to the current trends. And they feel like when things do go south from a demand perspective, that their business model stays intact and they're well diversified. All right. Feel free to enter any more questions for us. Ross asks, given that electric utilities are rate regulated, it seems unlikely that they will have much upside. Comments. Do you have a comment on the? I do.
Sure, go for it.
I would say, yeah, there is more limited upside because yes, their margins aren't going to quadruple, but their overall demand, remember, they're supposed to earn a certain percentage on each kilowatt, shall we say, that they produce and that is consumed. And so their profits can continue to go up pretty significantly as a whole. It's kind of like in a healthcare space. Healthcare providers have been limited in their overall profit margins. And so they've been incentivized to just grow the amount of spend within the healthcare space, and they still earn a certain percentage on that overall spend. And so what you're seeing in the utility space is yes, they're limited in what they can earn, but the overall spend, overall demand for electricity, it continues to go up. And that's why utility sector is still one of the best performing sectors on the year because the overall demand, as Luke talked about before, continues to go up.
Yeah, I would say that oftentimes as investors and as people, really, we think of things on a relative basis. And so, dividend yield, for example, people think about the dividends they're getting from a stock is a dividend yield, but you don't get paid in a percentage. You get paid in nominal dollars. And so, just because the profit margins aren't expanding doesn't mean that the dollars being distributed to investors can't grow. And so as demand grows, revenue can grow, profits as a whole in dollar terms can grow, even if margins don't expand dramatically.
Any more questions? There we go. Since for long-term buy and hold investors, would you approach investing in the AI picks and shovels from a basket approach, 10 to 15 stocks, or taking a full position on 1 to 3 companies that you really like? It's a great question. Well, it depends on your conviction in those 1 to 3 names. We would rather broaden it out, probably 10 to 15, versus just hang your hat on a few. You know, this is an area where there's going to be bombs. There's going to be ones that they look great today and they just don't work out. They either because of the dynamics within their particular subsector or maybe bad leadership. And so you want to, I would spread out my bets a little bit carefully, but I'd also be quick to get rid of them if they aren't working out very well, also.
It's also an area that faces a bit of a high regulatory burden. And so when a company is hedging a lot of its growth on particular projects, they can, through sometimes no fault of the company itself, be bottlenecked, hindered, not approved. And certainly that can really lead to poor performance of the company. And so anytime you have really high regulatory risk there, I think it makes even more sense because there are things outside the company's control to broaden and diversify across a basket like that.
Warren says, hi, Justin and Luke. Do you think the use of silver will increase with AI? What is your research showing? Great webinar. Thanks. Silver is typically an industrial metal, and as we know, the demand for industrial output due to AI is growing. So yeah, I think there's clearly a tailwind to the use of silver. So silver's always been kind of a hybrid, precious as well as industrial metal.
Looks like we had a question in the chat, and it says, would it make sense to just invest in an ETF by sector like utilities, given the secular growth? Yeah, that can certainly make sense. I think that broad ETF use in investing is a really good starting point. But I've always been of the opinion that you can further specialize in certain ways that can potentially give you higher expected returns. So if you go for a full utility sector ETF, that's really going to be agnostic of where the utilities are, right? Some utilities that are involved in electricity in California may consider or have excess risk related to wildfires. Some utilities in Florida may have a lot of risk and be exposed to hurricanes. So I think that as a starting point, these broad ETFs can be really helpful, but there are also thematic ETFs that you can invest in as well that can be more concentrated and have a little bit less risk in certain areas that maybe you don't want to take.
Yeah, I would go with if you want to do the work, like us, we do the work, we find the best within each particular sector that we want exposure to. But if you don't want to do the work and you just want broad-based exposure to utilities, I think that's fine to buy like an XLU, but know that you are getting other non-energy related utilities in there as well. You have water utilities, you have other types of utilities, even natural gas. Sometimes that can be AI related if they are connecting to some sort of gas turbine that's powering AI or something like that. But then there are other regions where it's just they're not getting much demand from the data centers. So it's just a bit more mixed when you're utilizing a broad-based ETF like that. Brian says effects of ending subsidies on things like EV and wind and solar. What are your thoughts on that, Luke?
Yeah, well, I think EV subsidies, individual EV subsidies, not really applicable to what we've been talking about here. Certainly, that has caused a growth in energy demand, but a lot of companies are now finding more efficient, more cost-effective ways to buy EVs regardless of the subsidy, right? Rivian's coming out with a cheaper model. Tesla's obviously made far cheaper models in the EV space. But even with the public investment tamping down, I mean, we saw it in that chart that showed the hyperscaler renewable energy spend. Private sector investment is not slowing down. So this really is a demand-driven thing that is likely to, even without public subsidies, float a lot of these sectors just because of the massive demand for energy.
And Mark says, the many investment choices in AI, where have you invested most? Oh, that's a good question. Definitely nuclear and uranium related. Then industrial would probably be next. Things like HVAC, copper miners. So, we think there's a lot of demand for copper because of the AI and infrastructure and modernizing the electric grid, et cetera. Those are areas that I'd say we have the most exposure. Would you add anything else to that, Luke?
Yeah, I mean, we certainly have exposure in hardware companies as well. Not
Hmm.
necessarily all the big, well-known ones,
Hmm.
but ones that really are providing, server rack exposure or various aspects that are maybe underappreciated, undercovered.
Yeah.
Right? We're
And
not we're
then,
not only investing in picks and shovels here. We also
yeah.
have investments in some of the bigger companies as well.
Yeah, and I would say software as well. We have some software names that are benefiting as well. Uh,
Robert said we already answered his question, so we can
okay.
skip on that one.
Delete that one. Nelson said, I've heard you speak often about copper related to AI, which I just did. Do you see opportunities in some of the current gold miners to modify or improve their operations in order to better leverage copper? Is an ETF such as GDX a good plan here? If I'm investing in GDX, I'm not thinking at all about copper. Maybe some of them will have some side benefits to their mines and maybe do have some copper there, but that's not their main source of earnings. And it's really going to be about whether gold prices continue to go up. And I think from a geopolitical standpoint, I think there's still a lot of tailwinds to the gold price. It's a little maybe overbought right now, so maybe you could take a breather. But I think there are some, good long-term secular tailwinds for gold. So I would never buy a gold miner because of copper for any reason. Says a couple years ago, the projection was commercial real estate was going to take a hit with higher rates now. With the current environment, with utilities, do you think financing here will be limited, or is this being funded by the tech companies? Well, commercial real estate is still in trouble, mainly in office, and it's been kind of a can that's being kicked down the road, and it's being dealt with kind of slowly. They're defaulting over time. They're figuring out ways to better use these facilities, trying to get their occupancy up. In some instances, we talked about it yesterday on the air, which is in New York City. They're converting a lot of offices to residential buildings as well. The Flatiron building in Manhattan is being turned into luxury condos. So I think that's where the issues were. I don't really think that AI is going to solve that
Well, I,
problem.
I think I think what he or she, because this is an anonymous
Uh,
attendee, was
yep.
asking is investment going to be rate affected in the same way that commercial real estate was rate affected? And I think that yes, utility investments can be pressured by rates,
Mm.
but the presence of the really strong tech balance sheets means that what you'll probably end up having is a bit of a bifurcation, right? Where smaller utility companies which are ones that are more likely to do debt financing rather than get investment from these massive, massive tech companies, may struggle a little bit, while some of these large developers, these larger utility companies, really have these partnerships with these hyperscalers. And so that leads to this bifurcation of the industry.
Got it. Okay. Interesting. Let's go to the next question. I love this one. Is KP invested in any SMR companies currently, small modular reactors? I love this question because I think this is probably the area that has the most risk to it in the nuclear space. I think there's a lot of hope that there will be small modular reactors, and this will be the new great way that these AI data centers are powered. But can you name one currently that is run by a small modular reactor? I can't. They're I think it was Amazon. They're hooking up to what is it? Three River? What's it called?
Your Mile
But
Island? No,
three,
no, that was Microsoft.
maybe it's Microsoft, one of the hyperscalers. They're connecting to existing large nuclear plants, and I think that is where that is where the opportunity is, at least for now. Maybe they get there at some point, but it's just a lot of hype. So it's not an area that we're buying into right now. We want names that are showing the goods today. We're chasing companies that have good balance sheets, good cash flows, good earnings, et cetera, not the ones that are spinning the greatest story. Tim says, you give any suggestions on HVAC, advanced cooling, grid build out equipment companies to look at? Well, we can't recommend particular companies. You can ask about one like you do on air, but there are areas, that is an area, excuse me, HVAC especially, that we continue to invest for clients into. So yes, of the opportunities within the AI space and the pick and shovel space, that is certainly an area everyone should have some exposure to. You want to pick one of these, Luke?
Sure. Where can we look to hear about international plans for AI infrastructure projects? I'm sold on HVAC. Most companies have very high PE ratios in the sector. Are there any contracts you can tell us about? Again, same type of thing. If you want to ask about specific companies, we can certainly answer them. But I will say that, oftentimes when you have these large investments, right, from these hyperscalers, there are public announcements about these global buildouts that you see public information about these building projects within these international spaces. And as you saw, right, from the chart that we were showing, the pie graph that was showing the amount of spending in the areas of the world, right, only 40% of it is in the United States, a lot in APAC, a lot in Europe. So the opportunities certainly are out there. Will
And
this be
then
available? Is it being recorded later? I have a doctor's appointment and have to run. Yes, it will be available on our YouTube.
and then are there any data center specific REITs as diversification? Do you prefer buying investment property or data center REITs? I think there are data center REITs that there certainly are ones that are out there. I think the biggest worry with the REIT sector is, and this is something that's underappreciated, is that they don't have a lot of flexibility in paring down their balance sheet. It's very easy for them to load up on debt to build out these data centers, for example, but they have to pay out 90% of their cash flow. And so they're not able to quickly repair their balance sheet as the income starts to come in. And so what to me, there's a lot of risk that they overbuild and then are stuck with an over leveraged balance sheet in a maybe a weakening pricing environment where there's overcapacity within the space. So I don't mind them as part of a portfolio, but certainly I think they have elevated risk because of just the structural dynamics of what a REIT how a REIT operates. You want to take the last one, Luke?
Sure, it says it would be worthwhile to consider the impact, it's more of a statement than a question, the impact on energy intensive industries such as mining as ore grades drop, energy requirements increase exponentially. Yeah, that's absolutely correct. As ore grades do drop, it means you have to mine more pounds, more tons of ore to get the same types of yields. And so there is a pretty steep exponential energy curves there. So that's another likely area of demand for energy moving forward. Excellent point. That's Thomas.
All right. We are approaching 1 hour. It's usually where we cut it off, but I'll leave it open for one more question if anyone has any.
And if you have any more questions, we do go live for Invest Talk in about 2 hours. You can just dial in there.
That's true as hell. Nelson says, you mentioned healthcare as one of the industries likely to benefit significantly from AI, given our aging population and the urgent need to modernize medical systems. What is your view on HEAL, HEAL ETF as a way to give an exposure to the trend? This is where I can pull up. Let's do this. There we go. Let's pull up HEAL. Ooh, Morningstar only gives it 1 star, so don't love that. Let's take a look at the holdings. Ooh, Hims and Hers, Tempest. Look like a lot of very risky names. Deep Systems, ResMed. Okay, interesting. It's kind of all over the board. It is 100% healthcare. What do you think about it being 1 star, Luke?
I mean, it doesn't usually, not necessarily an exclusion, but on its
Yeah,
surface, not a good thing either.
yeah.
Trying to pull up.
50 bips for expense ratio, which for a sector ETF, not crazy. It's a more of a mid-cap growth fund if you look at the way that the portfolio sits. So, historically, that's an area that tends to be very volatile. They tend to be, they're a decent size, but a lot of that can be hype versus true reality. So I don't love that. If I'm gonna invest in healthcare, I'd probably want companies that have more consistent uh, cash flow and business model. And so a lot of those smaller mid caps don't really have that. I'd want something that's more of a value focused. The Morningstar healthcare sector as a whole is more of a large cap value. I'm okay with it being maybe more of a mid cap value, but I'd want to be leaning on the value side of the market. What are your thoughts, Luke?
Yeah, I would agree there, right? It does tend to lean on the growthy side. It also, compared to other healthcare funds, definitely is on the newer side as well, because there's only about a 21 basis point dividend yield compared to the segment benchmark, which is about 1.73 at the same time. Again, pretty expensive and pretty small. The weighted average market cap, only about 20 billion compared to the segment benchmark of about 176. So highly concentrated. Certainly, about 60% of it is within healthcare support services and other medical devices. So, pretty concentrated bet within the healthcare space.
Yeah, wouldn't be my first sector ETF to buy. Let's see. Looking at AAON, you got the AON. So do you guys like AON for HVAC AI play? So what's interesting here is that they're not really gaining anything recently, right? Earnings have fallen from 216 to $1.35.
Yeah.
Yeah, so it's to bounce back, but look at the relative strength compared to, I don't want to bring other names up here, but you can see our comfort systems, right? Fix. Look at that. That's benefiting much, much more from the AI plays. So it wouldn't be my first way to play HVAC within the AI plays, but AI space. Matthew is asking about Palantir using AI and all the contracts they have been accumulating. What are your thoughts on Palantir, Luke?
Palantir is an interesting case because it is incredibly, incredibly, incredibly expensive, and it kind of weathered the storm of a cut in government contracts, right? This is a pretty agnostic a politically agnostic company. It was doing very well in the Biden administration. It's doing very well in the Trump administration as well. Now, the question is, does it justify the multiples that you're paying for it? What's it sitting at right now?
I'm sharing my screen right now, about a 300 multiple.
Yeah, I mean, you're taking on a lot of
Even
risk
if,
there.
yeah, if you're
And,
going
and that,
towards next year, I mean, that's a little bit better, but still about a 250 times multiple.
and that doesn't necessarily mean that it isn't going to continue to climb. But it does mean that if you are invested in it, and because investing is not just about returns, it's about risk as well, there is a lot of risk to the downside here. That revenue does not continue to grow at the 31% clip that it has. That net income doesn't continue to grow. I mean, net income is supposed to quadruple from 2024 into 2025. And so it's priced for incredible growth that may or may not manifest itself, but again, investing is about not just returns, but it's also about risk. And there seems to be a lot of risk to the downside here.
All right. Now, lastly, we have one more since it is 2 o'clock Pacific. It says, is it too late to get into crypto? If not, would it be better to get into crypto ETF rather than individual profiles as a beginner in crypto? Well, I will say, I'll bring up this chart, is as I said earlier in the webinar, is that Bitcoin has started to look pretty toppy, and now it hasn't started a downtrend. It's still kind of in a consolidation phase. It didn't break below the 107 level, which is the recent lows in late August. That's kind of the positive. It's still hanging in there, but from a liquidity perspective, there was likely to be an ebb in liquidity at some point next year. And when you get just look at what happened back in 2022, crypto went from a high around, or Bitcoin went from a high around 67,000 all the way to a low around 16,000. So when you go through the historical Bitcoin winter, the price of these assets drop considerably, and it likely will again, 60, 70%. Now, does it go to 150 before it goes down 60 or 70%? That's certainly possible as well. So I think you're late in the game from liquidity perspective, and it would not be a time that I would be going into crypto in a dramatic way. The way that we're playing crypto are actually companies that benefit from more interest in the space, transactions, things like that, and not necessarily from crypto going up or down. And there's a lot of great businesses out there that are catering to, let's say, the crypto community. And I think that's a more sustainable way to invest in crypto. Well, that about does it. We a little over an hour now, so I'm going to end it there. I appreciate you all tuning in for this hour, and look forward to connecting with you again on InvestTalk. And if you have any questions, don't hesitate to reach out to our office, schedule a portfolio review. That's going to be the best way for us to really give you more targeted advice and feedback on what you're doing and what your goals and strategies are. And we look forward to talking with you next time. Anything you want to add, Luke?
No, just like I said, if you still have questions, feel free to give us a call at 888 99 chart in about 2 hours.
There you go. Have a good day.